Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, let's take a look at UnitedHealth Group, the absolute behemoth in the healthcare insurance industry. They do almost $250 billion a year in annual revenue, or about $500 billion in total market cap. Let's figure out how much cash money this company makes. If we bought the stock today, held it for 10 years, how much we would make. Ready? Let's get to work. Okay, behind me we have the 10K for UnitedHealth Group. Now this is the 10K as of 2021. The new one's going to be coming out here in about 2-3 months as we round the end of the year of 2022. But I want to take a look at this healthcare provider because it is absolutely growing, and I want to figure out how much this thing is worth. And if the stock should drop, at what point do we pick it up as a bargain? Now, we're going to review this stock as we do all the stocks in the channel with the 5 key attributes that we like to look at. Number 1, top line revenue growth. We want to see top line revenue growing. Number 2, EBITDA, earnings before interest, tax, depreciation, and amortization. That must be growing. Number 3, strong free cash flow. Obviously, it's the channel. Number 4, low debt. We want less than 3 times debt to EBITDA. And number 5, we want a well-priced stock. And what is a well-priced stock? It's simple to say, it's hard to do. You want a stock with a conservative growth forecast that will beat the market on a IRR basis. That's all we're looking for. We want a company that is growing, low debt, and is cheap, or at reasonable value that if you bought it today, you'd make more than 10% of your money annually for the next decade. That's kind of the benchmark. The S&P 500 typically does 10% annual return for any 10-year period of point of time on an annual basis. And so we want to beat that. That's the name of the game. So let's take a look at UnitedHealth. I've got the 10K behind me. Obviously, always download and read all 10Ks before you make an investment and read them annually for any holdings that you have. I'm going to rip through this. Then we're going to take a look at 10 years of data and figure out what we think the forecast should be. All right, let's call out a couple things I thought was really interesting from the 10K. Okay, let's start by reviewing the 10K. I want to figure out where does the revenue for this company come from? Now, it's an insurance provider. They have UnitedHealth Group, and they have Optum Rx and a bunch of other portfolio companies. So let's figure out where they derive most of their revenue from. So in 2021, fiscal year ending, full year, revenue, mainly premiums, $226 billion of premiums for healthcare. This is people paying UnitedHealth Group as their insurance provider to cover medical costs that they might incur in the future. Products, that's them selling obviously products through their acquisitions and then services that go along with being a healthcare provider or some of their other ancillary acquisitions that they have done, such as I mentioned, Optum Rx. And then investment into other income, basically random. But this is $287 billion of top-line revenue for the company. The vast majority is basically premiums for healthcare. So now we know where they're getting, where they get their revenue from. What's it from? It's from premiums for healthcare providers. The next thing we want to do is figure out what brands they use to break down the revenue. So last time it was by category. This is now by brand. You can see the healthcare brand. This is the number we saw before, $222 billion of healthcare premiums. You can break that down to this portfolio of Optum healthcare companies. You've got Optum Health, Insight, RX, and then some sort of eliminations, which are probably intercompany transactions. But most of their revenue is coming from Optum Rx inside this portfolio, which is mostly healthcare premiums. Last thing, let's take a look at where they get their revenue from in terms of the type of customer. Most of the premiums that are being paid are from Medicare and retirement premiums. This is where the revenue for most of the $220 billion comes from. $100 billion of it is from Medicare and retirement. It's basically the U.S. government paying the healthcare premiums for people who are covered. That's fantastic. And then employer and individuals, $60 billion, and then commercial and state, $53. So they get most of their revenue comes from healthcare premiums. Most of that is in the Optum Rx brand name, and a big customer of theirs is the U.S. federal government paying for the Medicare setup. Okay, that was very quick, I get it, but I just wanted to give you a taste. You should read the entire thing to get more detail, but that'll give you a feel for where they derive their revenue. Their vast majority of the revenue is U.S. based. So if you are living outside the U.S. or have a portfolio of international stocks and you're looking for something that is that has very, very little foreign currency exposure, or you want exposure to the US dollar, this would be a very interesting play because unlike Facebook or Google or Salesforce or some of these other monster companies, this company has very little international revenue. Most all their customers are inside the United States, and they report in dollars. So that's kind of a little facet you might consider if you have a large portfolio of international investments. We covered this before. This is the income statement, but I want to just walk through the income statement really quickly. We covered this breakdown before of revenue by category. $287 billion is the top line revenue that they're reporting for the company. The cost here, medical costs, right? This is them paying out for the services that their insured customers receive. So they took in $287 billion of revenue, broken down by these various categories, most of which is just premiums, like you pay your insurance premium for your car, they're paying medical insurance premiums. And then they dole out, if you like the car analogy, accidents and repairs. This is medical costs, $186 billion. They've got operating costs. Operating costs would be their executive team, accounting, legal. It could be the rent and so forth. To actually run the business cost them $42 billion. Cost of products sold. So if they sold a product, $34 billion worth, and their cost of a product was $31 billion. So they make very little money on this segment. $34 billion of revenue, $31 billion of costs. That means that section for them really isn't much of a profit center at all. And then depreciation and amortization cost, that's a non-cash cost for businesses that they have purchased in the past and are amortizing. Total costing $263 billion. I subtract these two and I get a profit of just shy of $24 billion for the period, which you'll note is up from year over year. They've got some basically interest expense, which is very, very small. So most of this drops to earnings before income tax, and then you have tax and earnings. You also have, if I scroll all the way down, you've got the basic shares and fully diluted shares count. So 194 million shares outstanding. And then you've got your net income divided by shares, gets you your EPS, income per share. One of the reasons we don't on this channel follow EPS as tightly as other people report it is because earnings per share, EPS, can be manipulated by this number. This is simply the weighted average shares outstanding, or you can take this is diluted, this is weighted average. But this number is taking the $17.2 billion of net income and dividing it by the number of shares outstanding to get earnings per share. It's this number divided by shares gets you this. So if I have an earnings target, if I've told the street as a CFO that I'm going to make $18.33 in earnings per share, and my net income is falling short of what I need, I can buy back shares on the open market such that this denominator, this number, is smaller, to then take a smaller number, divide it into my lower net income, and boost my earnings per share artificially. A lot of companies do this, and it's one reason why we focus at the higher level on EBITDA, earnings before interest, tax, depreciation, and amortization, because it's not affected by the share count, and I want to know what the business as a whole is producing as earnings. Then we look at share count and cash flow per share and so forth. But let's keep going. Let's take a look at free cash flow quickly, see how much cash money these guys make from their cash flow statement on the 10K. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, cashflowinvestingpro.com, where I produce one-pagers like this one, summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at cashflowinvestingpro.com. Okay, here we go. Cash flow statement, my favorite statement, your favorite statement, the cash flow statement. Let's figure out how much jack these guys make. So we're going to pick up on our net income statement. The cash flow statement always starts at the top with the net income in the indirect cash flow method. Spare me the accounting mumbo jumbo, but a normal method is indirect, and it's going to be $17 billion. This is picking up from the income statement. So if you think on a linear path, you've got your revenue costs, your operating income, your net income. Then from net income, you turn that into cash by keep going down. So they just pick up The income statement is basically above this, and it flows through, and the change between the two is on the balance sheet. So we're going to pick up the net income, and I'm going to look through these costs, depreciation, amortization, share-based comp, and so forth, and I'm going to get $22 billion. So they made 17.7 of net income. That's in the income statement. But some of that is not cash. Amortization and depreciation, as an example, is a non-cash cost on the income statement. But if I'm looking for cash flow, I need to take this number and turn it into cash flow. So I add back the expenses on the income statement that I did not pay in cash. And I get $22 billion. That's a lot of jack. And that's actually slightly up from a year ago of $22.1 billion. Okay, so they made $22 billion of jack last year sitting in cash. Let's see what they did with it. So that's the cash flow from operation line, which is the first third of the cash flow statement. The second third is an investing section. So this is the investing activity within the company. So what do they do with that money? Well, they purchase investments. They sold investments and they maturing investments. This line here is basically them managing all this cash. Purchasing investments is not acquisitions. It's not buying machinery. It is literally buying treasury bonds because I have so much cash, I cannot possibly have $22 billion, or shouldn't have $22 billion sitting in a bank account. So what do I do as a CFO? I go to JP Morgan and say, hey, I need a T-bill, a T-bond, or a treasury security or a CD for $17 billion. JP Morgan says, great, here it is. I said, here. And I cut them a check and I say, here, JP Morgan, here is $17 billion out of the $22 billion I have in my checking account. Go put that in a treasury bond that matures in 6 months or a year. Right? So now it's protected. It's an investment, so they show it on here as a line item, but it's basically me taking my checking account cash and moving it to my savings account cash. It's not actually an investment. So I'm going to gloss through this, and I want to find two lines. Cash paid for acquisitions. Aha! It literally calls out acquisitions. This is me buying other brands and other companies. Remember before I had Optum RS Healthcare, Optum RX, there was a bunch of other healthcare providers. This is them doling out cash to buy systems, products, services, companies that they find interesting that they can sell to their existing members. I like that. And then purchase for property, plant, and equipment. This and capitalized software, this is CapEx. This is what we want. This is what they need to spend every single year to keep the machine rolling. The acquisitions can come and go, and that is a factor of growth. But just to keep the wheels going, you need to invest in the money in the business, and that's what this line is. Picture, if it's easier to think of, picture a manufacturing facility. You've got raw materials coming in one side, it goes in a conveyor into a box, turns the materials into some sort of object. Well, that is how you make your money, taking raw materials and turning it into an object. That box that does it needs maintenance, needs upgrades, needs new technology. That box is CapEx, and it must be spent to maintain the throughput and the quality of service. You can't skip on that. So for the healthcare provider, they're going to do the same thing. They're going to have IT systems. They're going to have new buildings for new locations, new tech centers that they need to manage the claims process for insurance claims, all kinds of stuff. And that's what this number is, and we want to pay attention. And then that's kind of the end of the cash flow. So they spent $10 billion, but not all of that is actually reinvested. What they really had to do was $2.5 billion. So they made $22 billion of jack. They carve out $2.5 billion. So basically have $20 billion left, some of it in a savings account, some of it in a checking account, but it's their cash, $20 billion. Now we go to the next section, the financing section. So this is how I invested my money. Now the financing section is, what did I do? Did I pay debt? Did I issue shares? Did I pay a dividend? That's what's in here. So we're going to check this out. Purchase a common stock, $5 billion. It's negative, means an outflow of cash. They bought back, they had $20 billion, remember, $20 billion. They bought back $5 billion in stock last year. See, it says common stock repurchases. It's negative. Negative means an outflow in cash on the cash flow statement. Next, dividends. They paid $5.28 billion in dividends. So these two here is $10.2 billion. Now what we want to do is we want to see, A, how much debt they have, and B, if they can afford that to keep going. Some companies, McDonald's, borrow money to buy the shares back that they're buying and can't afford it. And so you step into McDonald's or some stock and you say, hey, I'm going to rely on the fact that they're going to continue buying back shares and continue paying the dividend. However, that money was borrowed, that's going to stop. You want to make sure that they can afford this. And what we just did, we said they made $22 billion of operating cash. They reinvested $2.5 billion of CapEx. That's $20 billion. Well, $20 billion is much, much greater, actually 2 times as great as this share repurchase and dividend, so they can afford it, barring the debt. We're going to cover the debt in a second. That's $10 billion versus 22 or 20. They have $10 billion left. Now we're going to scan the rest of this, and we're going to see proceeds from stock issuance. They issued a little stock, $1.3 billion. So I guess you could net this and call it $3.7 billion of cash. But bear with me. Long-term debt, payments of borrowing of debt, and some various issuance of long-term debt. You can basically add this up. Add the payment of debt, and the borrowing of debt. This is kind of it looks like it's a net positive, call it $3 billion. Customer refunds, purchase and redemption of non-control interest, and then some kind of leftover rounded stuff. So the only thing they did is they did have a positive inflow of debt, meaning this $7 billion of inflow, it's positive. They borrowed money, and they also paid down on other loans. Think of it as having multiple houses. If you had several different houses, you borrowed one from one house. That's here. And you paid payments down on other houses. That's this. So this is 3.1 plus 1.3, that's 4.4. Less the 7 is, 2.3, I think? Mental math, it's late. Call it $4 billion of money in. But they didn't need it. $22 billion of operating cash flow minus CapEx leaves you 20, minus the debt, minus the share buyback and the dividend leaves $10 billion. They added to that with another $4 billion. So that's how the financing section works. And the very end is basically just the starting cash, the change of the entire statement, and the ending cash. So what we learned here very quickly, is they have positive cash flow from operations, and cash flow from operations can afford the CapEx, the debt, the CapEx, the share buyback, and the dividend. Okay, now let's put this all in context, put in some history, look at some multiples, and forecast this business. Before we start looking at this business history, just want to remind you that I teach a course. Definitely check it out, cashflowinvestingpro.com, where I teach you how to do all this work I'm going to do right now, and I give you this Excel sheet to do yourself. Also, if you're liking what you're seeing, don't forget to hit the subscribe button. All right, let's take a look at revenue. So 2013 to 2021, the next 2022 coming up, it's going to be a strong year, probably a double-digit growth year for them. $122 billion of revenue in 2013. That has grown to 130, 157, 184, 200, 226, 242, 257, 287. That's growth every single year for almost a decade. And looking at 3 quarters into the fiscal 2022 year, revenue is going to grow again. That's great. On an annualized basis, a consolidated average growth rate, they're growing revenue at 11% per year. Amazing. So that definitely checks the box for us on revenue growth. Now, EBITDA is at this channel, proxy for cash flow on the income statements, our measure of enterprise level earnings. Remember, you can look at earnings per share, but it can be manipulated by the number of shares outstanding. We want to zoom out. Business as a whole, what does the entire business do? Well, in 2013, it did just shy of $11 billion of EBITDA. Earnings before interest, tax, depreciation, and amortization. Why do you add back D&A? Because they're non-cash. Tax is non-cash too, because the tax that's expensed on the income statement is not the tax that's paid in cash. That's an entire different set of books. And then interest, well, we look at companies with very little debt in general, so this number should be small, but the idea here is that it's earnings before the financing structure, the capitalization structure in the business. Long story long, sorry about that. So $11 billion to 11.7, 12.7, 14, 17, 19, 22, 25, 27. Every single year, they have grown earnings. Wow, that's impressive. And they have grown earnings nicely. Here's the annual growth rate, some single digit. a period of very robust double-digit growth and then back to single-digit. They'll probably grow high single digits again, maybe low double digits next year. But I think this pattern of like kind of mid-single digit, strong double digit, and kind of cooling off is interesting. And I would not want to necessarily peg this as a long-term target going forward. But if I annualize this kind of overall 12% annual growth rate, 11% revenue growth rate, this 1% margin creep is widening as they get bigger. They're optimizing, and earnings is growing slightly faster than revenue. Great job. So we check these two boxes. Revenue is growing and EBITDA is growing over this period of time. Let's take a look at enterprise value and figure out what this entire business is truly worth. We're going to start with debt. Now, I want to explain what enterprise value is quickly. Enterprise value is like, think of a house that you might buy in the open market. If you bought a house in the open market, you bought it at the enterprise value of that house, because you go to the bank. If you're not rich, you go to the bank, you borrow a mortgage. That's debt. So if the value of the house, let's just say, is $1 million, and you go and borrow $700,000 from the bank, then what's left down here is the equity. That's what you come out of pocket with. You come out of pocket your down payment of $300,000. The bank owns $700,000 of the bank. What the stock market trades, the market cap, is just this equity piece, just the $300,000 you put down on the house, not the house value itself. Enterprise value is the value of the house. And to do that, you need debt, less excess cash, and market cap to get enterprise value. So enterprise value, $16 billion, has grown to $46 billion. That's a big, big growth rate. 13% annual growth rate, which is higher than EBITDA, but might still be sustainable because they've been growing earnings about the same pace as they've been growing debt. Excess cash. Remember all that $22 billion of cash flow that I said that they made in operations, and they cut a check to JP Morgan, hypothetically, for treasury securities of $17 billion? That is them putting money away into kind of their savings account. The way I measure their savings account for excess cash is the line called investments and short-term investments. It's called short-term investments on the balance sheet. That line is something that is kind of separate from their checking account, and I use that as my excess cash. So in that cash is $2.5 billion. They have a lot more cash on the balance sheet itself, but I'm only pulling what I deem to be excess. Market cap. Market cap is shares outstanding times price over time. I do it every year. And their market cap has gone from $74 billion, $75 billion of market cap to over, just shy of $500 billion, $460 billion of market cap. Now, if I add the debt and the market cap, less my cash, I get enterprise value, the true value of the business. Remember the value of the house. $500 billion last market cap. That is up from $100 billion, or 5x. It's grown 5 times in 9 years, or 5x in 9 years. That's fantastic. Really, really strong growth. So let's look at a couple metrics, ratios that we use. Net debt to EBITDA. This is our leverage ratio, right? We want to buy stocks with less than 3 times debt to equity. Why? Why does it matter? Well, in this rising interest rate environment, debt is becoming more expensive. Debt is a drain on free cash flow because I have to pay the bank back the money. And if debt costs are rising, that means my earnings or free cash flow are falling as the debt gets more expensive and I have to make that payment. It's also a risk of bankruptcy. If I can't make the payment, if the economy stalls and business slows down to where I can't make the debt payment, the bank will step in and say, I want to be repaid, issue shares, dilution, which is bad, or sell the business to a buyer, another possibly bad thing, or go bankrupt and sell the assets and liquidate, in which case the equity owners, the common stock owners, could get 0 of value. So no matter what the growth prospects look like to the business, always check that they're not over leveraged, because ultimately it's you, the stock owner, the equity owner, that will pay the price for a business that is over levered, not the bank. So it looks like leverage is actually coming down despite the total debt has grown from 16 to 46. Earnings that's used to pay that debt has grown from 10 to almost 30. So this has gone up almost 3x, which is more than this. It's about 3x, but it's basically in line. So yeah, the ratio has stayed in line, 1.4 to 1.6, very close, but it's less than 3 times, which is what we want. Okay, now, enterprise value to EBITDA, what is this? Enterprise value, that's what we just call the entire value of the business, entire value of the house, divide by earnings. You're basically paying a multiple of years. It's kind of hypothetical, but it's much like earnings per share or price earnings ratio. It's a relative measure of how big the enterprise is against how much earnings it actually generates. And you don't want to pay too much. This is what I mean by paying a reasonable price for a stock. If you overpay, it'll take too many years for the business to earn its money back, and you're not going to get the return that you're truly looking for. In this case, the stock's traded as low as 8 times, which means if I would have purchased the business at $90 billion of value, and it was at the time producing $11 billion of earnings, if they had no growth whatsoever, it would have taken 9 years to buy the stock back. 9 times 11, 100 billion. But what happens? It grew. This 10 went to 11, 12, it grew. So in reality, if I were to add up these numbers, that's about 90 billion. I think it's not popping up on the sum ad. But basically, if I add it up, it only took 6 years to pay off the $90 billion valuation because of growth, whereas if it had been flat, it would have taken 8 years. That's kind of how you can look at it. The more you pay, the more you're reliant on growth, which is a risk because the future is unknown. So this is sub 10, which to me is a great deal for such a big business. Then it grows. The market multiple expands to almost 18 times. This is a doubling, a more than doubling of this. So what happened to the stock price? The reason the enterprise value grew from a 5x is earnings grew, yes, but earnings didn't grow 5x. Earnings grew 3 times, 10 to 27. How did the enterprise value go from 100 billion to 500 billion if earnings is only growing at 3x? Well, the difference comes from the market multiple expansion. This expansion is the market saying, hey, this company's hot, it's growing, I want in, and I'm willing to pay a higher price. And so they went from, I'll pay you 10 times earnings to I'll pay you 20 times earnings. And what happens is the earnings grew, and the market multiple of those earnings grew, and you got an exponential growth. That is what we look for in this cash flow. It's one of the trifectas that we look for in this channel. A trifecta for us is a company whose earnings are growing, you get a market multiple expansion, and you get the stock buyback. We're going to cover the stock buyback in a second, but right now this market multiple expansion has already happened. Had you bought it here, you'd be at the trifecta category because you got the market multiple expansion. Okay, now I'll move on. Enough of that. Let's go to cash flow, figure out how much jack these guys make over time, and forecast. Okay, here we are. We've covered some of this already. So we covered this 2021 of $21.5 billion. Now this is adjusted cash flow. All I'm doing here is taking cash flow from operations, the 22.5 that you saw earlier, and I'm subtracting stock-based comp because I want to make sure we're expense the stock-based comp. So now I'm saying my adjusted cash flow from operations, 21.5, and that's up from 16.6 a decade ago. It's an annual growth rate of 16%, which is higher than my EBITDA growth rate. But the point here is they're growing in the same direction, which means the accounting team is expensing things properly. Good job, accounting team. I really want to see that. Stand up for yourself. Don't let the bosses push you around. Make sure you do what is right. It's really, really important. CapEx, we covered it before in a while. This is the number $2.4 billion you saw earlier. This is it in time. And what I want to show you, which most important, is the difference between these is really, really big. This is basically 1/6 of this number. And if I go out in time, it's 10% of this number. So it's going up in terms of percentage, but the dollar amount left over is really, really big. That's $20 billion that they can use to pay down debt. They don't need to. Their debt's very low, so that's $20 billion that passes through to whom? You and I, the equity owners. If it doesn't go to the debt, it's going to go to the equity owners. This is the debt schedule here, but I'm going to zero some of these out because while they're borrowing recently, the debt itself is minimal, so I don't need to count it in the cash flow because they can afford the debt. And I want to look at just putting debt aside for a second, 19 billion. Shares outstanding have consolidated nicely. It started the period with 1 billion shares. It's down to 956 million. That's a subtraction of 1%. Again, back to the trifecta. You want a company that's using free cash to buy back stock. That means that the company that you own, your ownership stake is growing over time without you having to put a dollar back into the business. I like that. If I take free cash flow as $19 billion, divided by this, I get free cash flow per share. This is what you get. This is your pro rata rightful ownership of within the company. For every share you buy, you own $20 of the free cash flow that the business generated. Whether they distribute it to you or not is different, but it's your pro rata ownership of that business. Here's the share price. So this is this is free cash flow per share. This is share price. This is my yield, cash flow yield, right? We're cash flow buyers. This is what businesses are valued on, is how much free cash flow. It's the only reason why you buy a stock. It's not for price appreciation. Price appreciation comes because cash flow is growing. You're buying a stock because you believe the cash flow in the future will be big, and that's what you want. 4.1% is the yield currently when you're paying a high price. It's been a lot higher in the past. I still have to get rid of some of this debt because it's affecting my yields. Let me just do this quickly. There you go. So cash flow yield has been in the 6% when the stock, in my opinion, was cheap at 8 times EBITDA. You're looking at 6 times free cash flow. As the market multiple expanded, the yield came down to 4%, which is a little low. Let's put back the debt, and now let's forecast this business. All right, forecasting the business is tricky. I'm going to be honest. There are lots of acquisitions that they do to help bolster the growth rate, as well as the organic growth that they have through price premiums and gaining members. So I'm going to do 10% EBITDA growth year over year, and I'm going to make it 5% thereafter. Again, they've had double-digit EBITDA growth recently here, but before that it was single digit. And I don't want to just take double digits and price it out in the future. I want some kind of upside for me. So I'm going to build a conservative forecast. Again, how do you define a well-priced stock? A conservative forecast that still hits. I'm going to put a 14 times market multiple on this stock. 14 times. It was last year at 18 times. It's been low as 10. So I'm kind of in the middle here. 14 times market multiple. That means my enterprise value, if I multiply these two, is $646 billion. I have debt, cash. I get a market cap of $600 billion. Less the shares outstanding gives me a share price out 10 years from now for UnitedHealth Group of $631 and change. Now, the free cash flow method is basically the same thing. I'm growing free cash flow year over year. Next year's $21.96. I get down to $34.07. I apply a 6% yield to that, and I get $567 as a free cash flow yield for this business out 10 years. Now we have 2 price estimates. We have one of the free cash flow method. We're saying we think the stock is worth $567 out 10 years. Another one we have is an EBITDA market multiple method right here, where we think it's worth $631 per share. I'm going to average the two because I don't know which one's right, and it's a future guess. Who knows? So I'm splitting the difference here, and I'll say just shy of $600. Now, right now, if I look in the market, I can buy as many shares as I want for $540 a share. If I look at what that current share price means, is I currently have an enterprise value of slightly over $500 billion. And the market next year's EBITDA is $29 billion. I'm paying just shy of 19 times for this business on a forward basis. And I think in the future, even though earnings will grow, the market multiple I'm using is 14. So that means over time, my market multiple is going to go from 19 to 14. That's going to weigh on my appreciation price. Even though earnings are growing, I paid a lot for the business, and over time, to be conservative, I think that number is going to come back down. That's going to weigh on price. So let's put this into an IRR and figure out how much we think we can make. Here we go. $540 per share right now. I get this stream of pro rata cash flow, which is mine. I exit at $5.99. And I'm making a 7% IRR on my stream of cash flow over this period of time. 7% is sub 10. It's under what we believe the S&P 500 will do if held for 10 years. Even with the conservative forecast, it does not meet the criteria for a market-beating return. Let's take a look quickly at what we would have to do to get close to that number. You have to assume 10% annual growth rate every single year to beat the market. So what the street, I think, is saying with the current price of $540 per share is that growth for this business is going to be someplace south of 10% every single year for a decade. And for me, that's a little too much risk. I don't like that much growth every single year for a decade. So I'm going to be conservative with my forecast. This means my current forecast is 7% return, and I have to wait for the price to come down before it becomes more attractive. So if I put it into a quick matrix just to say, well, what price does it need to be for it to become attractive based on the conservative forecast? Well, here we are at $540. If the stock gets down to $437, it begins to be even with the S&P 500's long-term return. So if it's under, the price is under $437, it becomes attractive to us, and we're going to start looking at the stock. That's how we want to try to figure out the stock. You put targets on companies, and you wait for the price to come to you. Investing is a subtractive game. There are literally thousands of stocks you can buy in the U.S. market, tens of thousands, 50,000 securities worldwide. You cannot possibly put money in all of them. You pick a handful. So the idea is to look at every stock, be conservative, and find the one or ones that fit the profile and then go with those. Let's review the 5 key factors. Number 1, top line revenue growth. Yes, it's there. Check the box. Number two, EBITDA growth. Yes, it's growing. Check the box. Number 3, strong free cash flow. Absolutely, it's strong. Number 4, low debt. Yes, less than 3 times. And number 5, well priced. No, I do not think it's well priced. What I'm gonna do is I'm gonna give it a meh. Now, I could have given it a bad, but I'm going to give it a meh only because I really like this business. I like the growth rates. I like the value. I like the stickiness of the insurance. I like the fact that it's medical. I like the size, how big they are in the market. There's a lot to like here. I just think it's too expensive. So it's not a bad investment. I just think it could be cheaper, and I want to wait for it to become cheaper. That's how I review stocks. This is my little vlog that I just showcase what my thinking is and how I value stocks. And I hope you learn how to do it yourself. If you're interested in learning more, I highly encourage you to check out my course, cashflowinvestingpro.com. It's in the description, the link below. I teach a financial course. It's 3 hours of content. I give you 10 years of financial information on Apple Corporation, and we go through it together. We build out this entire forecast. I show you how to get EBITDA, how to calculate share splits and reverse splits, how to use historical data to kind of, what do you do with companies that have split. I show you how to calculate long-term and short-term debt, how to calculate EBITDA, how to read income statement, how to read a balance sheet, how to read a cash flow statement. I give you basically a college course condensed in 3 hours, and you can download all the slides to watch as much as often as you like. It's a great course. I've had hundreds of people buy it, and really no complaints whatsoever. So I highly encourage you to check it out if you want to learn to do it. I even give you the Excel model that I just used in that course. You can do it yourself. So if you want to learn how to do it, that's how you do it. If you don't want to learn to do it, but you do want stock picks, then I highly suggest that you join up for the Cash Flow Club. There's a free Cash Flow one-pager in the link below. You can go to the website. The Cash Flow Club is a monthly subscription, and what it does is us and our analyst team produce one-pagers every multiple times a month. We're doing, I think we're about 15, 20 stocks per month that we're covering, and we kick out recommendations, some very, very interesting stocks. So what is on here? Well, what's on here is you get 10 years of historical financial data. You get a summary of the 5 key attributes. You get a forecast of EBITDA, a forecast of free cash flow, an IRR, a sensitive distribution table, and a summary with a stock chart of what we think the stock price is going to do. And let me tell you, some of the stocks out there in the market right now, because the stock market is down, we are estimating strong, all green, strong IRRs of 20 to 30% annually on some of these stocks, simply because the market is throwing away all the stocks together, regardless of cash flow. much like the stock market was just buying things regardless of cash flow previously, it's now throwing it out. And what you can do is you can pick up some true gems that you can own for a decade and make really good money on over the time. So I highly recommend you check it out, Cash Flow Club, where we produce the one-pagers. You can talk to us directly. It's a community of value investors that we argue about stocks, and we try to figure out where the best value is. Outside of that, if you want to throw a comment down below, it helps the algorithm. I greatly appreciate it. And tell me what stock you'd like to see. I'd love to take a recommendation, do a stock for you. My name is Cameron Stewart. This is Rational Investing. And up is going to pop right now, hopefully, a couple other stocks of value companies that you might want to check out some other videos. Thank you very much for the time. I greatly appreciate it, and have a wonderful day. Bye-bye.